Latma, right? Please, if you like what we do here, support us. How can you support us? You can become a member. You can donate to us, which is a tax-deductible donation. You can also follow us and share our news and updates. That's another great way to support us. Talk to us from a today perspective during the webinar. You can talk to us in the following two ways. One, our chat window is open. Two, if you have questions, which we hope you do, right? Put them in the Q&A window. We're going to be monitoring the Q&A window there. And last but not the least, at some point during the presentation, we will send out a link for a quick survey, really painless, we promise. But the more you tell us about what you're looking for, how we're doing, we can continue to improve us. So our activities. So do let us know. Next slide, please. So where can you follow us? Here are a few ways. We're on Twitter, we're on Facebook, we're on Instagram, and we have a website, all the usual places. You know how to find us. And we have some people on the board actually who are extremely connected within the Turkish American community. So we know you can find us. So without any further ado, let's go to the next slide and once again, formally welcome Bennet Goldberg. Bennet, thank you for being here. Bennet has decades of experience, both as a CEO and operating executive, but also on the other side of things, which is more the venture capital and as a board member and so on. So we're delighted to have him here. He's also got a connection that he's going to talk about in just a second to the Turkish community and background. So with that, let me hand it over to you, Bennet. Once again, thank you very much for being here.
Well, thank you, Dilshad, and thank you for inviting me today to speak to the organization. I don't speak Turkish. I'm sorry about that, but I do have, as you indicated, a Turkish connection. My maternal grandfather was a Turk. He was a civil engineer who studied at the University of Vienna in the early 1920s. Where he met my grandmother, and he later became, he actually graduated from the University of Moscow. This is in a brief period when Turkish and Russian relations were pretty good. He ultimately became a manager of textile factories. And in fact, there's a famous family photograph where the second president of Turkey, İnönü, came to tour the factory like you see sometimes, and he's in there showing him the factory. I think this was late 1930s or perhaps even during World War II. My great-grandfather was a physician who served in the Ottoman army during the Balkan Wars of 1912 and 1913. And my great-great-grandfather, Ali Seref Pasha, was what was known in terms of titular rank, a Feri, which is a lieutenant general in the Ottoman army in the 1890s. And he was the head of the cartography section of the Ottoman General Staff. So there is a connection. Now, given the global world that we live in today, I'm still in touch with relatives from the Turkish side of my family who live in Stockholm, Sweden, of all places, and in New York. So there's a little background there. But now bringing things into the 21st century here in Silicon Valley, you know, in the realm of venture capital, which is obviously a very broad subject, I kind of come at the subject from a triangulated point of view. And as Disha said in the intro, you know, I've done this from several different angles. So the perspective you may get is not that of a partner in a venture capital firm, but rather sort of triangulated all the way around that. I've raised venture capital as a CEO. I've served on the board or as an advisor to multiple companies that have raised venture capital from the earliest stages to the pre-IPO or late stage. I was an operating partner for almost 5 years for a private equity firm, which is a little bit similar and different from venture capital, but it's related. And I personally have invested in around 25 venture funded companies and over a dozen venture capital funds. And of course, there's a lot of processing of documents and so forth that you have to go through. So you quickly become very knowledgeable about term sheets and all the rest of that stuff. So, while my core experience is, isn't as a venture capital partner, the experience I do have has allowed me to understand, first of all, when does it make sense for entrepreneurs to even go the venture capital route? I mean, as a way to try to raise funds. Secondly, what are venture capitalists looking for when they even consider to make an investment in a company? Third, I'm going to talk a little bit about how to kind of do your homework about how to even approach venture capitalists when you have already decided that's the way I'm going to go. And then finally, and I think this is really important, what do they like to work with once they are part of the company's team? So, because that's also obviously a very important consideration. So let's start with the first one, which is sort of when does it make sense to seek venture capital? And the very first thing I would say on that point is it's about self-assessment. You as the entrepreneur have to really understand the number of things about yourself and what you're trying to accomplish. And and not in no particular order, but these would be the sort of 4 or 5 things that I think are, from my experience, are the most critical. And the first one is you have to consider to what degree is the product or service that you want to come up with or present, what is the degree of disruption or value added that you're creating? How significant is it really? Is this a big deal, or is what you're coming up with a niche product? And that doesn't mean that having a niche product is a bad thing, and it doesn't mean that you shouldn't market it and perhaps be successful. But if it is a niche thing, it's not going to be very attractive to most venture capitalists. And we'll come back to this a little bit, but that's the first thing, is kind of doing an honest self-assessment of how big could this really get in terms of its value added. The second thing is what's the size of the available market, or sometimes they call it the TAM, to address what you have. This can be very tricky. I was once on the board of a company, a very bright young man in the printing business. And he would start his presentation with how big the global printing industry is, which was, tens of billions of dollars. And I said to him after his presentation, I said, this is not a good way to start, because your solution is attractive, but this is not a product for the entire printing world. So focus in on the part that's actually relevant for what you're doing. And I know this may sound even almost a little bit obvious, but it's a problem. You see this happen quite a bit. People don't focus in enough. And you see that in particular, and I'll touch on this in another context shortly. You see this in particular when you have engineering background people who don't really have a sort of marketing or business background. So something to keep in mind. The third thing I'd say in terms of when you do the self-assessment is you should have a minimal expectation of the required behavioral change within the ecosystem to accommodate whatever it is you're inventing or bringing to the party. I can't emphasize the importance of that point enough, and let me elaborate on it a little bit. I can't tell you how many times, and I myself have been guilty of this, you come up with an idea and you say, this is so fantastic. If somebody would just incorporate what I've done into what they're doing, all they would have to change in addition to that downstream or this or that is X. Well, people are lazy and companies are lazy. And if your innovation requires not just that people adopt what you're presenting, but have to change something else, that can be a huge barrier to acceptance. And later on, maybe in the Q&A, if someone's interested, I can give some specific examples of that. But that's a really, really important point. The fourth thing I would say is do it when you do a self-assessment. Look at what is the competitive advantage of your product, not just what it does in the absolute, but how does it compare to competitive products or services. Now, the interesting thing about that is often you'll get somebody who's done their homework and they can compare how their product or service that they want to bring to market does compare to other companies out there. This company did this, but ours does it 3 times better, and so forth. sometimes you'll get the reaction, or people will tell you, actually, we don't really have any competition. We really are the first one that's done this, and there's no competition out there. So now what I'd like to explain is who, in 9 out of 10 cases, your real competitor is. And your real competitor is the status quo, because people are lazy, inertia is huge, and people will look at this and say, you know, it is kind of interesting. I could see where it might offer some improvement, but, you know, do I really want to change behavior? Do I really want to do things differently in order to do this? And so what that does is it puts enormous pressure on your product or service that you want to present to be not just a little bit better, it has to be an order of magnitude better. And here I use the term order of magnitude in the truly scientific sense, which means, you know, in the technical definition of it has to be 10 times better than what the existing solution is, number one. And number two, it has to be readily implementable. In other words, it require the most minimum of behavioral change. Very, very important point. And then finally, the other part of sort of your soul searching or self-assessment that you have to go through is, are you building a business that is what I'm going to call a lifestyle business, and I'll define that in a moment, or an exit-oriented business? And, you know, if what you want to do is say, look, I want to open a chain of 5 restaurants or 10 restaurants, but to really do that, I'm going to need external capital. That might be really interesting for you, because now you can be the king of your local restaurant business community. But, you know, that's not interesting to outside investors. You know, you want to open 3 car dealerships. It's a wonderful business. You could run it for the next 25, 30 years and make lots of good money for your family, but it's not interesting to investors. So you have to really understand, you know, what's the scale and scope of what you're actually proposing here? Not how big could it get, but how big can one, and when I say one, I mean the investor, visualize it getting? Because what's really important is not just you presenting your vision of how big this thing could get, but also how credible that is to people who are listening to your proposal. And I might add, are examining proposals all day long, you know, 300 days a year, and have been doing it for 10 years. They have quite the filter, that I can tell you. Okay. So the first thing, as I said, is looking at, you know, a self-assessment to understand yourself and your product and all of that. The second thing that's very important to look at is, will the need for capital be continuous? In other words, will the ongoing scope and growth of your business require more capital as the business grows? In fact, even more capital than could realistically be expected from the positive cash flows that you yourself will eventually produce through your product and service. I can't tell you how many times I've heard the notion from, you know, burgeoning young investors saying, you know, I think once we raise that first round, that's kind of all the money we're ever going to really need. And we will be cash flow positive. You know, maybe we'll need a little more money down the road, but it's really this first one that's the one that matters. And after that, we're golden. So that logic is extremely flawed from 2 standpoints. One is that almost never happens. Companies almost always need longer to get their product to market, need more time, and so it's inevitable that they're going to need more capital. The second part is and this may sound counterintuitive, investors are not interested in a company that's never going to need more capital, because when you say that you don't need more capital, you're basically communicating that your idea really isn't that big. Okay. Now, let me come at that and illustrate this from a different perspective. You see all the time when you look in the Wall Street Journal and the business publications, you'll see some, you know, unicorn or, you know, company that, you know, in August of last year raised $200 million. And my gosh, here we are it's only 6 months later, and they're raising another $200 million. Why are they constantly raising money? They're just diluting themselves and all of that. The answer is because they really want to be dominant in their market. And to be truly dominant in most markets, it takes, you know, not endless pools of capital, but significant pools of capital. And if you sit there in your business and it's successful, even cash flow positive most often, and you have no interest in raising money, what you're really telling the investors is, I don't want to get bigger faster. I'm kind of happy with it where it is. I want to control my growth, which, there's some validity to that. But again, that's not necessarily what venture capital investors want to hear. So now the third thing that, of course, you have to ask yourself is, will the advantages of working with venture capitalists outweigh the disadvantages? Now, just very briefly, and maybe in Q&A we can discuss this a little bit more, but let me just briefly go over what those advantages, and disadvantages are. One of the first big advantages, besides getting the money, obviously, the capital itself, is, the co-investment credibility that having a venture capitalist on board achieves for your company. Now, what do I mean by that? There are many investors out there, angel investors, other venture capital firms, that say to themselves, if I'm just using a couple of names that people have heard of, if Sequoia is interested in this company, then this has got to be a good deal. If Accel Ventures is invested in this, how can this not have a really good shot? Why? Yes, these are brand name venture capitalists, but the real reason goes well beyond that. Number one, the people making the investment have, as I said, looked at thousands of business plans and so forth. So if they invest, a lot of these companies will make literally 2, 3, small handful of investments per year. Now, Sequoia makes more than that, but a most solid venture capitalists, after looking at hundreds and hundreds of plans. So they're very, very, very picky. And before they make an investment, they do due diligence that is very, very extensive. Law firms, they'll even sometimes have accounting firms go in. No one should ever think that they're going to slip something by the venture capitalist when they look at making an investment. And it makes perfect sense. You're putting millions of dollars in, or hundreds of thousands. Why? Of course, you're going to be very careful. These people are not stupid. So you gain this sort of vetting credibility, which then helps to not only attract other investors, but I've even seen instances where when you try to sell to a company, let's say you're a very small company and you're trying to sell, your startup, you've gotten some funding, and now you want to sell to Walmart, or you want to sell to a big company. The thing that makes it almost tougher than anything else to actually get a contract or a customer is not that your product isn't good or that after beta testing it's worked. The problem from the customer standpoint is the concern, will you be able to deliver? In other words, is your company strong enough that they can actually feel comfortable that you are going to be around as a supplier? Well, if you then, in presenting to them in the first place, mention, that you're funded by, venture capitalist firm A, B, and C, I'm not saying that's going to put you over the edge, but it's certainly going to help. So the credibility really can't be overemphasized. The second thing is what I call scaling assistance. What venture capitalists can do is they can advise you, if you don't have the experience already, on, when is it time to hire the CFO? When is it time, now you're now at the stage, company XYZ, where, and they usually have a board seat. So, to say, look, this is a time for you to consider doing this and that. Moreover, most of them have either a stable of people they know or contacts where they can say, call this guy, this consultant that I know, they can help you, and so those are all the advantages. Now, there are some disadvantages. One is, obviously you're diluting your company, giving shares away in exchange. You are to some extent ceding control a little bit, not in the sense that they're going to control things, but you're not going to be able to control everything yourself. And by the way, parenthetically, if you demonstrate to a potential investor that you are a control freak, that's the ultimate turnoff, because a lot of conclusions are drawn from that. They're not a good listener. They think they can build a big company, even though, they're the one who does everything, and so forth. And of course, once you're in that world of the venture capitals, you are accommodating to some norms of how behavior in business is done. And so you're playing by the rules of the game, I guess you could say. So those are kind of the disadvantages. From my experience overall, obviously the advantages outweigh the disadvantages, because while there are the occasional companies that made it big without accessing venture capital, let's face it, it's not that many. Most of the companies that you hear about, the unicorns and so forth, were all venture funded at some stage. Okay, let me switch gears now to what venture capitalists are looking for when you're approaching them to get them to fund you. And there's sort of about 8 things, and I'll go through them very quickly. The first is you have to have a narrative, a story, as they sometimes call it. And usually that story starts with the customer perspective, or sometimes you'll hear it referred to as the pain point or the problem that needs to be solved. Nobody cares what you're doing in any context other than what it's going to accomplish. So that's really, really important. Now, you sometimes hear this expression, the elevator pitch. I've got to prepare my elevator pitch. The concept being that I don't know where this started, where you're in an elevator with a VC and it takes 30 seconds to get to the floor, and so you got to quickly buttonhole them and give them the story in 30 seconds. I think it's a little bit silly. I don't think that's a real world thing. It's more of a directional point. So yeah, the good news is you have more than 30 seconds, but you might not have more than 30 minutes. Okay, so a lot of first VC conversations are typically anywhere from 30 to 60 minutes, and that's it. And I mean, of course, there's always this thing of it can go over, and that might be a good sign and all that, but essentially plan on that. So have a story that sounds good, makes sense, that you're excited about. That's number one. Number two is, and you hear this a lot, and I just can't emphasize enough how true it really is, having a strong management, either a team or a couple of individuals who have tremendous respect and credibility, a lot of experience, leadership skills, deep domain expertise, and where you have the trust to say, okay, I don't know if this person's going to be the CEO when the company's public, but can they get this company, deep into the playoffs, if I could use an American football analogy. In other words, can these people take this company, quite far? And because no matter how good the idea is, if you don't have the people who can execute upon it, then it's just not going to happen, and they're not going to get the investment. There have been many times where people have presented to a venture capitalist and they actually liked the idea, and then they kind of gently suggested, or maybe not so gently, gee, if you would pair up with an experienced a business person, we could get more interested, which is a nice way of saying, love your idea, you're really a great person, but are you really the guy to lead this thing? Some of you may have seen or heard or even been involved with this concept in VC firms of EIR, or entrepreneur in residence. And what that is these venture capital firms often have sort of a team in the waiting in the wings of people maybe who have had successful exits that they have financed in the past, who are kind of looking for the next thing. And they'll sometimes sit in on these meetings. And if they get excited about it, this sort of like this deal or this idea of, maybe we can align everybody here and get this highly experienced entrepreneur who has domain expertise in this area to pair up with this, brilliant young engineer who has a great idea, but, that really has no clue on how to run a business. So, I mean, you have that times. Third thing is they look for something that is, you hear this expression sometimes, a platform, not a product. In other words, something that can launch further products, product roadmaps, and so forth. It's very rare that they're interested in investing in a specific product, because the assumption is always either somebody else will invent it who's already well established. If it isn't something that kind of can get deep into your system, whether it's an enterprise software product or something like that, they'll tend to shy away from it. Again, this goes back to looking for, in effect, big solutions. The next thing, the fourth thing is, does what you're offering offer some kinds of barriers to entry, protection against competitive competition? What's interesting is when you bring this up to people, this point, most often they interpret it in terms of intellectual property protection, patents, especially engineers. We already have 2 patents pending. You hear this all the time, and that's useful. But let me say that while that certainly can be useful, and it is not the be all end all. I would say this concept of barriers to entry typically falls into sort of 3 buckets of the kinds of barrier to entry you can have. One is this IP protection, patent pending, and all that, which is helpful. The second is, what sometimes people refer to as first mover advantage. You get out there quickly, you quickly, establish a dominant position in this particular area. And particularly if it's one where, while it's a big market, because that's what VCs want, it's not so big that now number 3 and number 4 and number 2 has that much of a chance. Big parentheses here. We all have heard of companies where you're the second one in and you actually ultimately win, but it's tougher. The first one always has that first mover advantage. And then the third barrier to entry, and I would argue the single most important one, even more important than the first 2, is, and it's very simple, know-how. What do I mean by know-how? I can't tell you how many businesses there are where what their real competitive advantage is, they know what they're doing. They can execute. They've been doing this sometimes for years, and they know all the nuances, and it's just really, really hard to replicate experience. And this is one of the reasons also, going back to an earlier point, why venture capitalists like to invest in managers who have, quote, done it before, because they know exactly what they're doing and they can trade on that. Then the next thing is, venture capitalists are very interesting in seeing, when you come to them, a product or idea, that customers will actually want to buy. Sometimes this is called product market fit, where you've demonstrated that your product actually, is targeting the market. And that's not unique to venture capital. I mean, even in, established companies, if you're a product marketing manager, your executive team wants to make sure that your new product idea has product market fit. The important thing here is, though, what they're not interested in is a product or service that you think customers should want to buy. Nobody cares what you think customers should want to do. They're interested in things where customers have told you that this is what they want. That's again, a hugely important thing. Yeah, I mean, I could go on all day about that. The next thing is this. Now, this gets a little bit technical in terms of the internal workings of how venture capitalists operate. And that is, they want to have an investment that can be marked up in terms of its valuation by passing that deal. Usually venture capitalists refer to companies as deals, up the food chain. Now, what do I mean by that? And I'll try to explain this as succinctly as I can. When a venture capitalist invests in a company, especially at the very earliest stage, they already know that the odds that this is going to be a liquidity event for them, that they're going to make money on this, they already know that the holding period is going to be 5 years, 7 years, even 10 years. That's actually how most of them are. So even though the value of this thing they've invested in could go up, they need to sort of show something to their investors, in other words, to the limited partners who've invested in the fund, that indicates that they have been successful. And so the only way they can really do that is to show their investors that this company that 2 years ago they invested, $2 million in, and at a $6 million valuation, now is out there raising money in a follow-on round where the pre-money valuation, in other words, the valuation before a second round of funding comes in, is, let's say, $12 or $15 million. Why? Because then when they make their report to their investors, they can say, oh, this company, it's not liquid yet, but it's already worth 200% of what we put in. It's a little bit gamesmanship, but that is how it works. And so this gets a little bit back to a point I made earlier about how when they invest in the first place, they want to be sure that there'll be a need for more capital down the road, because they need to demonstrate this to their limited partners. And let me just say, in parentheses, I said there's, let's say hold times 5, 7, 10 years. Most venture capital funds are raising their next fund after about 2 to 3 years after they raise the last fund. So in other words, they're raising money before they have any true demonstrated success from their previous fund. So they're even more motivated to show, I don't want to say phony profits because I don't want to be cynical about it, but let's say paper profits on these ventures with their valuations increasing, because that then justifies their presentations to their investors about what a good investor they are. So it's now this everything I just said now in these last couple of minutes is really internal, technical, how venture capitalists look at things. It really has nothing to do with the venture, what they're investing in. But it's very, very important as an entrepreneur to understand how they think and play that game. Okay, the next thing that they're looking for is, you hear this expression a lot, existing skin in the game. They want to make sure that you have either quit your job to do this because that shows dedication, or that you've already raised some money, several $100,000 from family or friends, because you're showing confidence in what you're doing. You're putting your money where your mouth is, even your relatives and your friends. I think we all know from experience, you never feel more on the hook than when your family and friends is invested with you. The sense of responsibility can be pretty overpowering, and that's good, and that's what they want to see. And finally, they're looking for the presenter to have a sense of confidence about what they're doing, not just because it shows conviction, but because they're also imagining, okay, can I picture this person leading a company, right? So you could be the most brilliant engineering person, but if you're not really someone who is going to be comfortable presenting to a crowd or showing leadership or interacting with, investors and CEOs of other companies and things like that, so confidence is important. And together with that, that confidence communicated with an absence of bullshit. I mean, they sniff bullshit like if it's such a thing in venture, if the minute an investor thinks you're bullshitting them, you're out. I mean, it's that clear. Okay. So let me move on now to how to think about and approach, sophisticated angels and institutional venture capitalists. And again, I'll try to move through this fairly quickly. The first thing you'll want to do is, research and cross-reference venture capital firms in terms of sort of two broad buckets: the size of their fund and their domain focus. Most venture capitalists today, and this has become increasingly true, and I'll talk about this at the end when I talk about how the industry's changed over the last 5 or 10 years. More and more venture capitalists sort of stratify themselves into, and you'll hear this expression sometimes, a Series C and Series A investor, or we do the middle rounds, A rounds and B rounds, and then you hear this expression, late stage investors, meaning money that comes in almost before the company goes public or exits. So different venture, and there's exceptions. There's many stories where it's typically a Series B firm, but they heard about this thing that is a seed and they get excited about it and so forth. So, in general, you really want to understand what stage you're in, and then make sure that you segment the investors you're even thinking about talking to on that basis. And as I'll explain in a minute, it's not really that hard to do. The second thing is look at what they tend to invest in. You have some venture capitalists who, for example, only focus on the consumer market. You have others who say, if it's not business to business, we're not interested. We're a SaaS company. So you really have to understand sort of where you fit in that ecosystem. And since there's literally hundreds of venture capital firms, start screening out, the ones that like, hey, it's not that they may think my idea is interesting, it's just it doesn't fit at all what they're doing. So that's step number one. And very quickly, how do you figure that out if it's not something you're experienced with? Well, first of all, if you have friends or associates that have had funding, you can kind of ask them, people who are involved in this arena. Crunchbase, if you're familiar with Crunchbase, which is a part of the TechCrunch family, you can go on there and you can research. If you hear about a venture capitalist firm, it tells right on the website, or any company that you've seen. You can see who invested in, sometimes even how much. So this information is more publicly available than I think people realize. And then there are actual databases that allow you to sort of cut, slice and dice some of this. Now, I don't know how up to date they are or how complete they are, but they are out there. So researching and cross-referencing the VC funds by what you're doing is sort of an important step. Second thing is reaching out to contacts who have a professional relationship with angels and early stage VCs. You know, your friends who've gotten funded. That doesn't mean that the company that invested in their company is going to invest in your company, but at least it's kind of like, you know, a communication vehicle and so on and so forth. Third thing is prepare a deck to hone and underpin your narrative. The biggest value I've found of the deck is not like, oh my, I'm going to have a great deck and I'm really going to blow away the venture capitalists that are meeting with my deck. The main value of the deck is to organize your own thoughts and help you develop that narrative. That's actually the main value of it. But it's good to have one, but don't depend on the deck to communicate it. There are a lot of VCs who will even say, a very common response when you first have contact with a venture capitalist is for you to send them the deck before they even have the meeting. And then at the meeting, it's questionable. Some of them don't even want to see the deck because they want to get to know you. They want to hear your idea. They don't want to like sit there as you're reading a slide presentation. So I'm not saying, when you have that presentation, not to have a deck, but I think people have a little bit of a misunderstanding of what the purpose of the deck actually is. Next is make sure you have something tangible to present by the time you get to the stage of seeking out venture capital. What are we talking about here? Well, a real demo that actually works of the product, a report on beta site activity from beta sites that have tested the product, feedback from potential customers, and of course, ideally, actual customers, even 1 or 2 customers, because people see customers as extraordinary validation. And finally, that you have a team. I mean, even if you're the only one presenting by yourself to the venture capitalists, have an explanation that it's you, if you're the technical person, you and your business partner, if you're the business guy who's actually who's running the technology behind the scenes. If you're literally all by yourself, that's a very tough sell, with one exception. If you've done it before and you've had a successful exit, then those venture capitalists will be all over you to want to invest, and they figure you'll figure out these. There's one specific example that I have some direct familiarity with, where somebody I know started a company, had a very high publicity exit, then decided to start their next company, put a deck together. This person then approached a well-known investor, started to go through the deck. After page 4 of the deck, and I'm not exaggerating, the deck was maybe 20, 25 pages. After the 4th page, the investor said, okay, you can put this away. How much money do you need? That's sort of the difference in credibility if you've done it before successfully. I think it's helpful to do homework about everything we're talking about, kind of taking this conversation and sort of moving it to the next level. And there's a couple of blogs that are very, very helpful. I'll say the names really quickly. There's a guy whose name is Ash Rust, who I have a lot of respect for. He runs a small seed fund called Sterling Road. But more important than his seed fund is his blogs that talk about, very early stage pitching. And you can see that blog on, the URL is ashrust, ASHRUST.medium, MEDIUM, medium.com. And if you go on there, and then another one is called, it's a little more, I don't use the word sophisticated, but it's a little bit more grounded. It's in almost like a pedagogical sense, called the Seraph Compass, SERAF. Then another important thing is begin to develop a relationship months before you expect to need the money, so to speak. It's common to be in touch with seed investors well before they invest. It's a good thing. Sometimes you'll show them something, they'll say, look, we're not ready to invest now, but keep us in mind when you do this, and they'll actually tell you what the milestone is after you've got a customer or after you do this. And so you develop a dialogue. Don't go to them like when you're running out of money next week. And then finally, and this is also kind of a subtle thing a lot of entrepreneurs don't get, is make sure to hire a law firm that is highly experienced in working with venture capitalists. most of these law firms, there's, 7 or 8 of those in Silicon Valley. We all know these names, Gunderson, Detmer, Wilson Sonsini, it's what I call the usual suspects, Goodwin, Proctor. Most of them have programs for entrepreneurs that allow the legal costs to be deferred until the venture is actually funded. Now, of course, there's a little bit of play there, because if they don't even think you're going to be funded, that could be a little, but it's worth doing. This is not a case where, so to speak, any lawyer will do. You want to get someone who knows what they're doing. Okay, let's wrap this up. So once they're on board, how does that relationship work? Well, first of all, almost all VC lead investors will expect to receive a board seat. So if you're even, I don't know if I want them to have a board seat, particularly in these early rounds, it's a given. So it's very important. This goes back to something I said, early on in this discussion, of making sure you're comfortable with the investor. And sort of one of the, I don't want to call it downsides, but one of the things is, these people are going to be on your board. So now, having said that, most of them don't have the time to do more than an occasional consultative phone call and to attend quarterly, or in the beginning, maybe monthly or every other month board meetings. You hear a lot about these rapacious vulture capitalists and all that. My experience is that, you see some of that when a company is really in danger of sinking, that they start getting more involved, and logically, because they're trying to protect their investment. But as long as things are going even reasonably well, they're so busy doing other things, they're not going to be all over you. The other thing, once they're on board, is, as I said earlier, they can be very helpful in identifying resources that can be useful. And, specialized consultants helping with recruiting, helping you determine the timing of making recruits, et cetera. And also recommending best practices in terms of scaling and enhancing the valuation. The VCs tend to focus, as I said earlier, on the continuing capital needs of the company and helping companies with their process and raising subsequent rounds of funding. I mean, that's the thing where their self-interest really comes to the fore, as I was explaining earlier. You wonder, how come these guys are always so interested in advising me about how I need to raise more money? So that's that's part of it. Okay, so how has the venture capital market evolved in the last 5 or 10 years? Well, first of all, there's more capital available for venture deals than ever before. And I don't mean a little more, I mean a lot more. Venture capital has become almost like a consumer popular thing. Just everybody wants to get into venture capital. So there's it's very funny. When I first got involved with this in, like the early, like mid 1990s, if you had a fund that was about 100 million, 150 million, that was a solid, typical venture fund, 100 to 200 million. Today, that's a seed fund. I mean, you're talking about, I remember when it was a big deal when the first time a fund raised $500 million. Then it was a big deal the first time they raised $1 billion. I mean, this is all, average stuff these days for certainly for the top 25 or 50 funds. The second thing that's changed in the last 5 to 10 years is that, for the most part, they expect higher thresholds of achievement to receive that first check, and that's that can be a little discouraging, but it's healthier. There was, if I remember back in the 1999 2000 .com boom and crash, there used to be this expression: just go to meet them at the breakfast meeting with a PowerPoint. Well, those days are over. Nobody's investing on a PowerPoint unless you're someone who's done it before, as I explained earlier. But other than that, no, you've got to come to the table with something more tangible. Third thing is that I've already mentioned that the funds are larger, but also the check sizes are bigger. So people will joke and say today's Series Seed is 5-10 years ago Series A. I remember once for a company raising a Series B, and that Series B was $5 million. I mean, that would be a joke. This is 20 years ago, but that would be a joke today. I mean, $5 million is somewhere between a Series C and a Series A. So, check sizes have gotten bigger, which, by the way, has also, to an earlier point, put more pressure on your idea being really big, because they need a place to put that capital. There's also today, compared to 10 years ago, greater specialization, focus, like I said, by investment stage, by the industries they invest in. You still see some venture capitalists saying, oh, look, as long as it's a good idea, we'll follow up on it. And there is some of that. And they all do make exceptions from time to time. But primarily, they all focus on, their 3 or 4 favorite areas. And then finally, what's changed is the valuations are higher and the holding times are longer. So I can tell you from like in the 1980s, it was very common for a company to go public if their revenue was at around $100 million. Not that, or even less, but I mean, if you were a $100 million company, you weren't just venture funded, you were pretty much ready to IPO. Today, it's hard to go public if your revenue is less than $1 billion. So it's a whole different scale. And that, of course, has led to there being more and more bigger funds who invest at later stages with, like Andreessen Horowitz, where they write, 20, 30, $40 million checks. Okay, well, this concludes what I've presented, and I know I've gone much longer than I probably should have, but I hope it was reasonably thorough given the time that we have, and I'm happy to answer any questions that you have.
Absolutely, very thorough, but also opens us up to all kinds of questions we can explore. So we have a bunch of them. I'll start queuing them up. Thank you very much. I mean, I've been taking notes, definitely, and some of the sites you mentioned, whether it was the 2 blogs, Ash's blog and Seraph Investor, I passed on the chat window, as well as a few of the legal firms you mentioned with the VC experience. But let me start kind of with one. It's actually one question, but 2 parts, 2 sides of the same coin, maybe. Very high level. What do you see as the hot areas that actually find VC support more recently? And then the other part of the question is, what do you think is a hyped up area that probably shouldn't be having as much support? What is the big hype, even if there is one in your mind?
Right. Okay. I mean, again, there's always exceptions, so you want to be really careful in some ways. But I think the hot areas right now are frontier, what they call frontier. So this is all these like space exploration things. You hear about SpaceX and all of that. And by the way, sometimes you almost have to roll your eyeballs a little bit. There'll be 1 or 2 companies in a new area that have been amazingly successful, and suddenly everybody wants the next thing that's like that one. But this so-called frontier area in the last few years has become very, very successful. Another area is cybersecurity. That for very tendentious reasons has become very popular. Health, no surprise, all these teledoctor things and all this, especially now in the COVID era, has become very, very popular. So that's another one. Another one is things with big data. Those are hot areas. Areas that have been, they're not hot like just in the last 2-3 years, but let's say in the last 5 or 6 years is SaaS, software as services. That of course has been very, very popular. Again, this goes back a little further to all the success of the Salesforce and these kind of companies that are more like from 10 years ago. But that's also very popular. So I think those are probably the but then again, as I said during the presentation, you have venture capital firms that focus on certain niche areas that are maybe not these big themes that we're talking about. But anyway, those would be the main ones I would think. Probably missing 1 or 2, but
no, that's wonderful. Frontier, I had actually not heard that kind of label before, so that's very interesting. Even small companies that put up satellites, probably, that specialize
that's
in
all
that.
frontier.
It's very interesting. Okay, cool. Another question is much more focused around changes that the last year of lovely pandemic state brought to us. What in the VC space, if any, changes have we seen? You talked a lot about the last 5 to 10 years and the funds and also the size of the investment increasing. But how about the last year? Have we seen some big changes, whether it is from the money supply perspective, or actually one thing that's interesting to me is, there was a belief that Silicon Valley was really partly very important because there was a full ecosystem here, from the entrepreneurs to supply of work power to money, right? And that was more of a physical ecosystem. But is that shifting? Is that getting more distributed? What are we seeing, and what's the impact as you see it?
Okay, so let's unpack that a little bit. I think first of all, there's been almost no impact whatsoever in terms of money being available. I mean, it's as if, I mean, things are getting funded all the time. This has not stopped them from working. I mean, I think many of you have seen, even in your own professional lives, and this is sad a little bit. It's the restaurant workers and restaurant owners and people who have significant interaction with customers who are really suffering in this so-called K recovery and so forth. But let's face it, for most people who are professionals and working on Zoom, everyone you talk to says pretty much the same thing. They're actually surprised at how normal it really is this whole time. And we don't even want to talk about people who are saying that they're more efficient and effective working on Zoom, which we've also heard from numerous people. So all of that is really no change. Okay. As far as what the impact of COVID has been on the kinds of investments that are being made, I would say, what you hear is that it's just accelerating trends that sort of were existing anyway. So this sort of telemedicine thing, for example, was already a thing before COVID. It's not like that was invented during COVID. But yes, of course, the companies that do those kinds of things are getting more attention, and startups that focus in that area or some aspect of that area are getting more attention, so on and so forth. To the third part of your question, about the Silicon Valley specifically impact on the logistics of where people live and all that. That's a really interesting question. I would say it's a little bit too early to tell. You read a lot in the press about people moving to the two cities you always hear about are Austin and Miami. Those are the two that the press is always covering. I think there is some truth to that. I do think that there are companies that are saying, especially for backroom operations, why are we paying Silicon Valley salaries when somebody can do this? I mean, it's sort of like, it's just like call centers moved to the Philippines and India, 10 years ago or longer. There's a little bit of that too. It's like, why do these people have to be in Silicon Valley? I think that as companies now are going to be moving, as we come out of COVID, more to this hybrid model where people only go to the office, a couple of days a week, that now enables people to live, 2 hours away from the Bay Area instead of 30 minutes from their job. And then, of course, there's a number of companies who've announced that they're not going to require people to come to the office at all, and you can live wherever you want. So I think that is going to that leads to a sort of diffusion of the Bay Area not being the be all end all. And secondly, and this, I don't know if this is even really COVID related, is there are a few other places that have sort of really come up in terms of where venture capital goes. And I'm thinking, again, this may change because of COVID, but New York has become really a very strong area for venture capitalists to invest. Many of them now have offices in New York. So that's another aspect of that diffusion. So I think, to the thrust behind your point, I think it is something that has to be watched, but I don't think we've yet seen sort of this wholesale leaving of the Bay Area. I've read an article recently that said that when they looked at all the people selling and moving out, for most of them, it's moving from the city of San Francisco to, Napa or the suburbs. So, we'll see. I think this
or
is
the
still,
mountains. Yeah.
the jury's still out on this one.
Yes, I absolutely agree. Just one follow-up question. You said we're seeing more in New York, more investments in New York. Is that in the tech space in general, or some of the non-tech areas, or it's just kind of distributed? You don't.
I mean, it's not black and white, but I would say, media is much bigger in New York. And it turns out that some of the most successful seed round in venture capital firms are actually based in New York. Union Square Ventures, for example, a lot of people have heard that one. Spark Capital. So there's a handful of fairly major, not major in the sense that they have $10 billion under management, but they're just go-to companies that have done a really good job of financing startup companies. So yeah.
Wonderful. Thank you, Bennett. Another question is kind of an extension on something you've already touched on specifically. You talked about the importance, what VCs look for, IP, first mover advantage, know-how, etc. On the first mover advantage topic, one of the questions says, how important is that a business venture idea is unique in securing investment, or first, not just the uniqueness, but which are two different things potentially. But we see a lot of Me Too type ventures that with the right funding, operational muscle, become the leader in a space, even though they're not first mover to market. I think you spoke to this a little bit, but do you want to expand any more on it?
Yeah, sure. I mean, the thing is that it's always better to be the first mover in a certain sense, but there are also many examples for decades already where, as good as the first mover was, it still had certain flaws, or actually through usage, people realized that while this has been a great innovation, it still has certain things that just aren't quite where we need to be. Sometimes those original companies evolve and fix those things on their own, but sometimes it takes somebody else getting in to kind of leapfrog that company. I mean, let's put it this way. You'd still rather be the first one than not be the first one, generally speaking. But it also gets to why when I was talking about that, I said there were really sort of three things. It's either or, and IP protection, first mover, or know-how. And I think when the second one takes over from the first one, to your question, it's usually because they have the know-how better than the one who actually came up with the idea. One of the most classic, almost business school case study type things about this is back in the late 1980s. I'm going back a long time now. There was the first major spreadsheet, some of you may remember, was called Lotus 123, and it completely took over. That was the standard in offices until Microsoft came out with Excel, which was a much easier to use product and so forth. And so it took over, and Lotus eventually they got sold to IBM, and it more or less went away. But okay, that was Bill Gates. So I mean, it's like he'd already had a very successful software company. So I mean, yeah, but all things being equal, let me put it that way, first mover advantage is better.
Okay, awesome. Thank you very much. Let's see, just as kind of relating to this community, a question that's more exploring a specific community. How do cultural connections play a part in funding ecosystem in general? Which kind of also, there's another question that came that relate to it. Do you invest in Turkish startups? Which I would turn it more probably and take it more like, does investment flow in a way that actually has cultural connections, kind of tying it back to the original question?
I would say yes and no. And let me talk about the no first, but I'll actually focus more on the yes. Yeah, I mean, and generally speaking, money is money, and most investors want to invest where they see the opportunity. And let me put it this way: I don't think they're prejudiced in the sense of, oh, these people are coming from Turkey, so we're not going to, I mean, if the idea is good, they're going to invest in it. Okay, so for the most part, I think there are a few areas that are as egalitarian in that sense as money. Okay, it's a commodity. But I do think that there are certain ties that help. I do think that certain ethnicities, this is, you always want to tread lightly when you start getting into this arena, but I mean, it's a well-known fact that I think it's either 30 or 40% or something of successful Silicon Valley startups are founded by first generation or immigrants, particularly Asian, Indian, Chinese, and so on and so forth. I think people get that now. I think that's kind of well entrenched. So I don't see that as being a barrier. And yes, of course, there will be people who maybe are from those ethnicities and social circles, so they'll be more interested in that. Where I think this area is still sort of a challenge, or where you read about it a lot is with women. Women, you hear a lot about it's tougher for women, and there now are venture capital funds who specialize in funding women companies. There's even, I think it's called Cowboy Ventures. There's actually a venture capital firm where their whole thesis is they want to invest in women founded companies. So you do have some of that, but I have to say, in the big scheme of things, I think it's kind of, I don't want to say on the fringe, but it's not exactly central to the whole picture. Now, there's one interesting firm, many of you have probably heard of it, called 500 Startups. It's essentially a seed fund. And they came out already, I don't know when they started, around 10 years ago, maybe even a little longer now, who literally invest all over the world. And so what I mean is, if you take, let's say that it's not about Turkish Americans. I mean, they will actually make investments in Turkey with Turkish entrepreneurs who live where the company's in Turkey, that kind of thing. Or, I'm just using that as a relevant example here, but I mean, they don't care about any of that. They don't care about borders. They don't care about, so they've received a lot of, publicity around that. And then I would say, just to conclude on this point, most VC firms now, in the wake of, sort of what's happened last summer with the Black Lives Matter, all that, they know more and more have now sort of gone back and re-examined their mission and, looked at our commitment to diversity and all this kind of stuff. And, I think, I don't want to be, I think good things have come out of that, but I mean, I think it remains to be seen how influential all that really is. So I think that answers the question.
It does. Thank you, Bennet. Let's see. Let's switch to, we talked a little bit about the different funding stages, not in, great detail, but especially on the seed side. And you made the wonderful point that says, they want to see a commitment. The VCs want to see a commitment from you. Quitting your job is one, and focusing on this. Another one is the seed funding, family and friends. Can you tell us, what are some of the differences in what a firm, maybe investment firm, may be looking for at the early seed to A stage funding in terms of attributes versus maybe a little later in the B to stage funding?
Right.
Although they may be different firms focusing on different areas, they may also be repeat investors, I assume. So.
Right. So let me say this just very briefly, and I know this is not an area where, I focused more on seed and A. I didn't really focus on later stage, but understand the differences in risk profile and also how they're looking at it, because this is their business and they want to make money. So a couple of key points. One is, when you're a venture capital investor and you're investing sort of Series B, Series C, that kind of a thing, your overall return rate that you're expecting is a little bit less. In other words, you're expecting a little bit less of a return because you're investing later, okay? And that there's no way that you're going to make 100 times as what the early investors made. But you're willing to do that because what you're gaining for that is lower risk, because the odds that the Series B or Series C company is going to survive and be successful is significantly higher than the seed or the A company. So you're basically saying, I'm willing to take a little bit of a lower return in order to have less risk associated, number one. And the second thing is, and very important, is the time to exit is shorter. So one of their common measurement tools is what they call IRR, internal rate of return. So they tried to calculate, on an annualized basis, how much am I making off this company? So a company that returns twice its capital, that's a portfolio company. But if it exited in only 3 or 4 years from the time you invested, that's just as successful in terms of your internal rate of return as the Series C and Series A investor who may have gotten, 7 times their return, but it took them 10 years to get there. So, mathematically, you can figure out where those two curves cross and you break even on that. But the fundamental point is they invest at a later stage and they trade off some element of risk with some element of, great return, but not as great. That said, getting even, more pinpointed response to your question, they're still looking for growth. Even at a Series B to Series C, they want to see high growth, because what they want to make sure of, obviously, is that, this company hasn't sort of finished its fast growth stage and now it's going to sort of, move along at a kind of very slow pace, because then the concern is, I don't think, they're thinking themselves, I don't think the valuation 3-4 years from now is going to be all that much higher than when we invested. So there's still a tremendous focus on growth potential, even when you're investing in sort of Series B and Series C.
That's very helpful. Thank you, Bennett. Another one, I kind of try to group questions together as they relate to each other, is one question is, do you invest in Turkish startups? That's a very specific question, but I think the general question is, are VCs generally interested in small startups? Not generally, but are VCs interested in startups outside the US as well? And you mentioned this in the 500 startups example, which is a much more affinity group kind of investment maybe, but I'll let you answer that.
Sure. You know, the short answer is no, not really. It's I have to chuckle a little bit when I say that. This is not a question of, you know, prejudice or you know, that sort of thing. It's just most Silicon Valley companies until recently, there are name brand venture capital firms who until a few years ago hesitated to invest in companies that weren't in California. So forget Turkey, Germany, France. They didn't even like to invest outside of the West Coast. Okay. Now this has changed. You know, more and more companies are investing in, you know, Minneapolis or, you know, Florida or something like that. But if you actually look at their portfolio companies and you look at where the headquarters of these companies are, you will still find them to be vastly overrepresented by companies located in geographies that are near them. I once heard somebody, a major VC, address this point, and what they said was, you know, it's not that we're against investing somewhere else, but we have so many great opportunities locally, and I got to go to board meetings and get in my car. It's just easier for me to do one locally. It's a simple, you know, almost like it's as simple as that, you know. Now, after what I just said, you can imagine where I'm going to go with my response about how likely they are to invest in a company outside the United States. And the answer is not that likely. There are a couple of exceptions. There have been some high-profile venture capitalists that have invested in China, although more commonly it'll be like a Chinese American venture capital. Probably the most prominent one now is the one called GGV. So it's a huge one that it has offices in China and the United States, and they'll invest in both. India is another one where you see that. But I think the more important development over the last 5-10 years, well, maybe closer to 5 years than 10 years, is you're seeing more venture capital firms springing up in those countries. Now, are they usually these billion-dollar funds? Not that much. Those kinds of investments are typically made by sovereign wealth funds or local investors that are not what we would classically look at as venture capitalists. But there are venture capital funds now in many countries that sort of take care of that.
Wonderful. Thank you. That's very helpful. So I know we had actually scheduled this from 11 to noon Pacific time. Thank you. We're past the noon time, but if you have if you can give us a few more minutes, maybe we'll
Sure.
queue up 3 more questions, last 3 questions, and then we can move on, if that's okay, Bennett.
Sure. No problem.
Awesome. In that case, let me switch to again, you touched on some of these, but I want to make sure maybe we package it up for our listeners. Any suggestions, do's and don'ts in business plan and fundraising? I know you talked about a lot of them a bit, but let's just kind of bring it back together and say business plan, fundraising, do's and don'ts.
Yeah, I mean, I think that it's more important for the entrepreneur to have their story together, to be able to demonstrate either what they've done already or be very clear about what they're going to do more in the short range. So, when I think of a business plan, I think of, a 5-year plan or something that shows your numbers out for 5 years. It's all BS. I mean, nobody really believes any of those numbers more than 1 year out or maybe 2 years out. So the way I would put it is it's best to take what I would call a bifurcated approach in the following sense, that your business plan or business plan concept can paint, as I said earlier, a narrative where the person you're talking to can visualize how this thing could get really big. And if you do that well, that covers sort of the long-term part of the conceptual plan, but then get very detailed about the next 12 to 24 months, exactly what I'm going to do now, or this is what I've already developed. Here are my next steps. Okay. So the long term is covered by the vision of where you're going and successfully communicating. Here's how big this thing could get. To now attach numbers to it, I mean, you can do it. It doesn't hurt, but this is not where the attention is going to be focused.
Got it. Got it. Thank you. So a bit more of a detailed question. We kind of hovered at the higher level, but let me just kind of take this one. One of our listeners writes, I'm at a crossroads right now. I can position my startup as a premium service or a low cost service. Can we just expand a little bit on, from your perspective, what do you see as the pros and cons at the stage, the kind of startups that you invest in, for example, from what you see? So premium service versus a low cost service.
I don't think there's a clear answer to that. It really depends. I mean, it's a classic example of the devil's in the details. A low cost service has to still meet those hurdles that I described earlier of it has to be something innovative. Somebody really has to use it. Behaviors don't have to change to use it. All those things still hold true, whether it's low cost or not. The pressure on when I hear low cost service, what I think I'm hearing is high volume. And if it's a high volume business, then you basically, in your plan and in what you present in terms of your capabilities, you have to be able to demonstrate why this is something that's going to get extremely wide adoption and why your skill set and your experiences will make it credible that you can actually achieve that. If it's a premium product that is, I don't want to say niche-y, but more of a high end, more exclusive type product, or very expensive or something, that can also be presented, but there you're going to have different criteria. Again, one of those criteria is there a risk that the market is now too small for that product, so that while it's a great product, it'll never have sales more than $5 million, that kind of thing. So, I mean, again, this is a very, you have to look at it, each idea on its own. But I don't think there is a rule that says no, only very expensive, high value added products can be successful, or you need to have high volume or forget about it. I think it does depend.
That's and I totally understand. So another one is more, maybe less about the investor side and more about you're starting a startup, and specifically, I think the question goes like this: how do you stay positive and keep moving when nothing seems to be working? Well, much more to the psychology of a founder.
It depends on what nothing is. If one of those things that nothing is working is your product, you've got a problem. So I think it really depends. I think, though, going back to the sort of the first part of what I talked about, which is what I broadly called the self-assessment, or the assessment of the short list of things that you really have to be honest about. Again, always ask yourself that question: is this something that people actually want to buy, or is this something that I think they should want to buy? And it's very easy to rationalize and sort of build up a narrative in your own mind, like, I don't understand why everybody doesn't want this. They should want this, right? You just have to really be in touch with that.
Okay, I said 3, but I keep kind of getting a couple more pings here. So I will just add this one. Will it be advantageous to have minority in the management team as you're meeting with potential investors?
So first of all, before I even answer that, when you have that first meeting with venture capitalists in general, especially at the seed round and Series A rounds, they don't want to see anyone else but either the CEO or the CEO and the technical, 1 or 2 people. They don't want a whole team going in. Now that's different, somewhat different when you're in the later stages, but in the early stage, they don't want a cast of thousands coming into the room, first of all, regardless of what your ethnicity or whatever is. I don't think, except for those funds where I mentioned briefly, there are people now who are talking about, diversity and so on and so forth. I don't think it really matters. at that very first stage. I just don't think it does. Now, if you're an established company and you're a Series B or Series C and you have, 120 employees or whatever, right? And like you have no diversity in your management team, that's not good. I mean, so it's more what your company looks like as it evolves in terms of addressing the issue than what it is like the day you walk into your first meeting with a venture capitalist.
Absolutely. Okay, wonderful. I think we got a few things about how can I reach Bennet? Does he provide advisory or mentoring type support to entrepreneurs or folks who are thinking of starting up a business or who have started a business? I don't know if you want to answer that in the air or you want us to follow up. I'll leave it up to you.
Well, I mean, I'm essentially retired from a professional standpoint, and I'm on the board of 3 companies now, and I've been an advisor from time to time. But in general, I don't really review people's business plans that I don't. It's usually people who I've known before, or family, sometimes even family members, or people I've known for a long time. So it's I always have to be a little careful because I do have a lot of experience in this area, so it's very easy for me to get swamped very quickly. If I put myself out there that way. So I do want to be a little bit cautious about that. I don't want to say I'll never, but
yeah, totally.
Yeah.
Totally understood. Well, thank you. Sorry for putting you on the spot there, but that's exactly okay. Why the question came a couple times. So I wanted to make sure.
No, I mean, if somebody here's, let me maybe say one other thing though, very specifically. If somebody is in a situation where I tend to add the most value and where I've been the most involved in recent years on sort of addressing your questions, if somebody has already raised a seed round or has, they're at that stage where they have 2 or 3 investors competing to invest, where they're kind of like at least that level are involved, and they're looking for somebody to be, an advisor in a more formal sense. That doesn't mean like someone you have coffee with. That means someone who is participating, maybe has, found some shares in the company or something like that. I mean, sort of like a non-cash finance consultant. I've done that before. I'll meet with someone and they just basically want somebody who has experience to help guide them through these, different stages of funding and all this kind of stuff. If I find it interesting, I'll do it. But where I'm not really getting too involved is someone says, "Hey, I've got a great business idea. What do you think?" That's sort of too early, so to speak, for me.
Makes sense. Thank you very much. So I think maybe what we'll do, it's 12:21 over here on the Pacific Coast. So we're going to once again, thank you, Bennet, for being here with us and sharing just a small portion probably of your vast knowledge and the know-how in the space, both on the company side and on the investment side. We've benefited a lot from it. I see the thank you notes, both privately and coming into the chat window. With that, I think for today, we're going to be ending our session. This will be available also on our YouTube channel as a recorded session, so we can actually share it with folks who have not been able to make it at this time on a Sunday. So thanks again and have a great Sunday. Thank you to all the attendees also from the Turkish American Association of California.
Well, thank you for inviting me, and it certainly was a lot of fun, and I hope it's been helpful and interesting. So thank you.
Very helpful. Thank you.
Bye-bye.